quickly go over with a quick supply and demand strategy for you guys in 2024 and show you guys how I take my trades. I trade smart money concepts, basically. I trade order blocks, supply and demand zones, and imbalance gaps, which are similar to fair value gaps. I have videos on imbalance gaps, but I just trade that, and I trade the news, and I trade market structure, and I personally believe market structure aligns with the news. So setting the news aside, the first thing I like to do when I go on the chart, guys, is I like to identify market structure. And so the first thing that I do is I'll go to, like, for example, I went to the 2-hour time frame, and I noticed that it looked like there was some liquidity down here. Then I went to the daily time frame. Sorry, guys. Oh, fuck. Hold on. I think I just went to the wrong pair. Hold on a second. Alright, here's the right pair. Alright, so I went to the daily time frame, and as you can see, there was something I noticed. So overall, we're in a downtrend. But if I zoom really in closely here, look what I noticed, guys. I see a liquidity, or a double bottom here, which is, for me, liquidity. And smart money usually will target liquidity because that's what the retailers buy off: support, resistance, trend lines. So I target liquidity for my take profit. So here is a confirmation that we may still be going low. And what I'll do is, if I go to the 15-minute time frame, overall, if I zoom all the way out, structure is going where? Bearish. We're in down structure, right? And so for me, okay, so if I know that I'm targeting, I want to make money selling rather than buying here because we're in down structure, now that I know I identify my market structure, I can start looking for what I like to call POIs, points of interest, that I'm interested in taking trades at, okay? And those point of interest for me can be order blocks, supply and demand zones, or imbalance gaps, like the market gaps that usually occur when there's aggressive selling in the market or buying in the market. So like this aggressive selling right here and this aggressive selling right here, these can indicate gaps, and usually you will find them in areas like this, okay? Because the market healthy price action looks like the arrow down here on the bottom, up, down. There's not really many gaps here. But over here, we have a lot of aggressive movement going downwards, and that's where we want to look for our imbalance to potentially target and look for entries. So what I'm going to do is I'm going to go here, and let's go back to the, first let's go to the 30-minute time frame, because I like to look for imbalance gaps here, or you can call them just gaps. Okay, and then since we're selling, we know that we want to sell on the top part of the range, because the top part of the range is called your premium part of the range, and the bottom is the discount. So when you're buying, you want to buy at what? Discount prices. And when you're selling, you want to sell at premium prices. So since we're in down structure, we're going to sell at premium prices. So if we divide the range in half, we notice that the top of the range and the bottom of the range are separate between this line. The top of this line, or the line itself, is where we're going to enter trades. So up here, above the line, this whole area, and these areas are where we're going to look for our POIs. So for us, I'm going to look for gaps. So here, let's go to the 2-hour. Let's check the 2-hour and look what we notice right here. So I noticed two things that caught my attention. So we have liquidity here. We have a double top here, which I'm sure retailers are going to sell off. So I'm going to write my liquidity line there. And I also noticed that, what do we have, guys? Within our current trading range, and by within our current trading range, I mean our current low here and our current high here, we have found the gap. And where is the gap? Let's zoom in even more. The gap that I'm interested in looking for potential trades, guys, to make money are right here, above this line. See this 0.5 line? There's a gap right there. And yes, I'm going this slow because there's a lot of new people here. And this gap right here. And if you noticed, we zoom in even more, these are the areas, like I said, we're going to be looking to take potential trades off of. And what am I going to do after that? Okay, so now that I have these areas, I'm going to mark my box or my gap from wick to wick. So this is the gap, the actual space in between the candle, but we're going to mark it from wick, the top of that candle, to the bottom of that candle. And then we're going to drag it like this. And then for the top one, we're going to drag the top right here from wick to that wick. Not the candle, the actual wick. And so you notice the bottom of the box that I just drew is touching the candle wick, if you guys notice right here. Okay, so now that we have our points of interest identified, which in this case I noticed gaps rather than order blocks. So in today's example, these are our gaps, or you can call them imbalance gaps. So now that I have my points of interest identified, I'm going to drag them up here, and I'm actually going to wait for price to come up to these areas. And how will I know when that happens? So if you guys have stuff to do, here's what I do. For me, I will actually take a line, and this probably works if you have TradingView Pro, but you should be able to do at least a couple of alarms. Take a line and outline before the box, and then set an alert. And when you set an alert, write POI for points of interest. And your point, like I said, your point of interest is areas of interest that you're interested in taking trades off of. So they're not necessarily, yes, we're going to enter right off that zone. They're just areas that we've identified that we have confidence in. Okay, so let's create an alarm. So what I just did, guys, is I set an alert on that black line to so I know when the market has reached my area of interest. So even if I'm not on the computer, I know. And so what I'll be doing now is I'll wait until price reaches the box, and then within this gap, I'm going to look for a potential order block to break structure to confirm that the market is indeed going down. And if it's not an order block, it can be a gap. Like if it just touches the gap here and then it just goes down, that's completely fine. So what I'm looking for is basically this: the market to come up here. And one confirmation, guys, when you're trading, when you're looking for your entries, when price comes here, when price comes to this gray box, usually if smart money is in the market, you will see a wick touching the box instead of actual candles. So what I mean is like this. So you see that little line, pretend that's the candle wick. So you would see wicks touching. You want wicks to touch your areas of interest. You don't want the candles to hang out in here and build and just chill here. You want it to just tap and go. And so once you see a candle, a candlestick, a candle wick tap that area that you've interested, that POI, which in our case, like I said, is imbalance gaps, then you want to go ahead and identify a break of structure with aggressive price action. So we need 2 pieces of structure broken, or 1 piece of structure broken with aggressive price action or unhealthy price action, like you saw in the past. And then what we're going to do is that's going to confirm our to enter. Oh shit, sorry guys. So here, if it came there and it did that, right, I would want to see it to come down and break these current lows here. Okay, and once it does that, we can identify our new range, because structure may be changing because we've broken 2 pieces of structure. Okay, so the trend can be changing. And so our current high is here and our current low is right here. So this would be our current price range that we would be focused on. And so like I said again, since we're selling, divide the range in half, and then we're going to sell on the premium side of the range, which is what? The top of the range, and discount is at the bottom. So we're selling at premium prices, because when price is higher, that's when we want to sell. Okay, so we're going to wait for the market to come back up. It's going to go like this a little bit and hang out. It's going to be, the candles are going to be small and smaller because it's retail. And so when it finally enters our area, then that's where we're going to look for our risk to reward, and we're going to take our risk to reward tool out and actually enter our trade here. And what we're entering itself can be either an order block, or it can be an imbalance gap like you just saw above with the gray box. Now the thing is, guys, when you're trading order blocks are just simply large sums of money being injected into the market by big institutions or banks. And so these target areas, after they've done that, are now become points of interest, like I said, for entries. And within these order blocks, 50% usually will get filled, and they usually occur at the top part of the range or bottom or even the middle part. And so order blocks there's actually some order blocks right here, but they're not the type of order blocks that we trade here. So there's order block right here actually. You see how there's an engulfing candle, a black sell candle engulfing that. These are order blocks. So this was a small trade placed by an institution likely, or a bank. I'm pretty sure it was an institution selling here at this previous place. And so even this can be considered an order block, but things like that, these are all considered order blocks. But the type we trade are the type that are at the bottom of the of the market, or at the top of the market of a range. So let's say this was our current range right back here. You know, we had market going up, down. We had an order block which was what? Down here. This order block caused all this unhealthy price action to break this previous structure right there. And so even though we don't have an engulfing white candle, this is still an order block. Because sometimes I notice they won't always engulf. And we have another order block right here. If you see, sorry guys. Fuck. Hold on, let me do it again. Son of a bitch. We have a order block right there. You have a bearish engulfing candle, and then we have a wick here, meaning that they targeted this previous order block here. And so when you, like I said back over here, once this breaks your two pieces of structure, you're going to look for another point of interest, which is either what? A gap, which you already previously saw the example at the beginning part of the video, or an order block like I just explained. And those are your only two options of entries. Okay, so that's literally it. Those are the only two things you're going to look for. And so this first example up here, right? These over here, what you're seeing on the screen now, these are imbalance gaps. These are gaps. That's one type of entry that we take in you know, when we're trading smart money. And the second type of entry that I take are order blocks. So those, you saw the first entry. The second type of entries are order blocks like this, order blocks like all these little tiny black candles you see, black arrows that you see on the screen. So you can either take trades of order blocks and imbalance. That's all I trade, in order blocks and imbalance. And then the way I find correct order blocks and imbalances are using market structure. Market structure will show you the right order blocks and balance, because market structure shows you who's in control of the market. Okay? But yeah, guys, this is just a quick tutorial. The step number one, identify your market structure. You can use the 15-minute time frame and up, 30-minute time frame, 1 hour. Then when you identify your market structure and you know, like, when you have like your high, your low, your lower high, your lower low, then you want to identify the current range, which is the current high and low, which we already did in market structure. And then you want to, like, if the market structure is going upward, you want to look for entries, which are your order blocks and your gaps at the bottom of the range, which is the discount. And then when you're selling, you want to sell at the premium part of the range rather than sell at the bottom. Okay, because people that buy at the top usually have fear of missing out. So you know how the retailers, the average person, when they sees the stocks go up, they buy right here at the top. They buy right here at the top, rather than waiting for it to retrace, buying the dip here, and then profiting going upward. People don't really do that. But yeah, guys, this is just a quick video. I hope it wasn't too complicated. If you guys want to watch more of my videos, they're on here. Connect with me on Instagram. It's in the comments or in the section of whatever you're watching this of. I hope you guys had a good day, and peace.